Usually when we look at a restaurant menu, there's this expectation of boundaries, an unspoken contract, really.
Right, like a focused value proposition. You want them to stay in their lane.
Exactly.
Yeah.
You go to a burger place, you expect, a few variations of a burger. You go to a sushi joint, you get a list of rolls. It's categorized and contained.
Which is just the conventional wisdom in the restaurant industry. I mean, you're supposed to do one thing, do it exceptionally well, and minimize your operational complexity.
Keep it simple, maximize the profit, but then you step into the Cheesecake Factory and suddenly those boundaries are just obliterated.
Totally, it's a completely different animal.
You sit down and they hand you what is essentially a spiral-bound novel. I mean, you're flipping through pages and you've got like Jamaican black pepper shrimp right next to a chicken taquito.
Yeah, right across from shepherd's pie and miso salmon.
It is an overwhelming sea of choices. It actively defies every rule of operational simplicity that we just talked about.
It really is the absolute definition of culinary maximalism. And from an operational standpoint, honestly, it shouldn't work.
Right. Because how do you even manage that?
The sheer logistical nightmare of keeping that many disparate ingredients fresh, cross-utilizing them effectively, and training line cooks to execute, 250 different dishes?
Insane.
Doing that perfectly during a Friday night dinner rush is a monumental task.
And reading through their corporate financials feels remarkably similar to reading that massive menu. There is just a huge amount to digest and a lot of hidden complexities underneath the surface.
There really are. It's a dense read.
So, welcome to another deep dive. Today, our mission is to cut through the Wall Street jargon, synthesize this sea of data, and extract the most actionable, fundamental insights for your portfolio.
Because that's what we do here.
Exactly. We've spent the morning tearing through a stack of sources, specifically the Cheesecake Factory's ticker symbol CAKE, their official Q1 2026 earnings release, the full transcript of their live call with analysts, and, all the accompanying financial tables.
And there's a lot of data to unpack.
There is. We're going to break down the headline numbers, the real story driving those numbers on the ground, management's guidance for the rest of the year, and ultimately, whether this is a bullish or bearish signal for you as an investor.
And much like that massive menu, there is a lot more going on under the hood of this company than just the namesake desserts.
Right. It's not just cheesecake anymore.
Not at all. We are evaluating a multi-brand operator that's attempting to navigate a wildly complex consumer environment, balancing their core legacy locations with these really high-growth incubation brands.
Yeah, and I want to dive straight into the headline numbers, because looking at the top line, Q1 delivered what I can only describe as a rather staggering surprise.
It really was a shock to the street.
Right. Total revenues hit $978.8 million. I mean, we are talking about nearly $1 billion in a single 3-month quarter.
It's massive scale.
And looking at the notes here, that meaningfully beat the high end of management's own internal guidance.
Yeah, that near $1 billion figure is huge, especially when you consider the broader context of early 2026. I mean, the restaurant sector has been dealing with intense consumer fatigue.
People are just tired of spending.
Exactly. But Cake pushed right through it.
Yeah.
It wasn't just, empty revenue.
Right. The bottom line looked good, too.
It did. If you look at the bottom line, their adjusted diluted earnings per share, the EPS came in at $1.05.
Wow.
Yeah, that is another clear beat against expectations, and it represents double-digit growth year over year.
I mean, for anyone holding the stock, seeing double-digit earnings growth from a mature brand in the casual dining space feels like an anomaly right now.
It's definitely not the norm.
But here's the metric that really caught my eye, and we need to talk about comparable sales. The Cheesecake Factory's comp sales grew by 1.6%.
And just to clarify for everyone, comp sales means sales at locations that have been open for at least a year.
Right, so it strips out the artificial boost of just opening new stores. Now, isolated, 1.6% doesn't sound like a rocket ship. But the sources point out they outperformed the Black Box Casual Dining Index by 40 basis points.
Which is a critical piece of context.
But let me stop you there just to make sure we keep the jargon translated for everyone listening. When we say 40 basis points, we're essentially talking about less than half of 1%, right?
Correct. 100 basis points equals 1%. So they outperform the industry average by 0.4%.
I mean, that sounds like a rounding error. Why is a 40 basis point beat something to write home about?
Because the casual dining sector right now is a zero-sum street fight. The pie isn't really growing.
Oh, because discretionary spending is tight.
Exactly. Consumers aren't adding extra restaurant visits to their monthly routine. So if you are growing your comparable sales while the broader industry index is sluggish or lagging, you aren't just treading water.
You're actually taking a bigger slice of the pie.
You are actively stealing market share. You are taking a customer who used to go to a competitor on a Friday night and convincing them to come to you instead.
Wow.
So that 40 basis point outperformance proves they have gravitational pull in a really stagnant market.
Okay, I see the gravity of that outperformance now. But wait, we're looking at the whole portfolio here, and they aren't just the Cheesecake Factory anymore.
Right, the incubation brand.
Yeah, they have these sister brands, and looking at the tables, one of them, Flower Child, absolutely knocked the cover off the ball. A massive 10% comparable sales increase.
Yeah, a 10% same-store sales bump in a single quarter for an established concept is just staggering.
It's huge.
It indicates that the brand isn't just growing, it's catching fire and becoming a destination.
I definitely want to get into Flower Child later because I have questions about how they actually scale it. But before we celebrate these revenue beats and that 1.6% comp growth for the core brand, I need to look at this with a skeptical investor's eye.
Fair enough. Let's hear the bear case.
Well, we're living in an era of persistent inflation. So when I see revenue beating expectations, my immediate cynical thought is, are they actually building a stronger business? Or are they just charging you $3 more for a slice of red velvet cake to mask a shrinking customer base?
And that is the exact tension Wall Street analysts were probing during the call. To answer it, we have to look under the hood of that 1.6% comp number.
Okay, let's unpack that.
Comparable sales are a blend of three distinct levers: price, mix, and traffic. According to the management data, price increases accounted for positive 3.3%.
So your instinct is partially right. You're paying about 3.3% more for your meal than you were a year ago.
Exactly.
Okay, so price hikes are doing the heavy lifting there. What about the other two levers?
The second component is mix, which came in slightly negative at minus 0.3%.
And when the industry talks about mix, they're referring to the actual composition of what people order, correct? Like choosing chicken instead of steak.
Precisely. It's the ultimate metric for check management.
Check management?
Yeah, so if a family of four comes in and feels financially stretched, they might split 3 entrees instead of buying 4.
Oh, I see.
Or they skip the $15 signature cocktail and just drink water. Or they pass on the dessert. When that happens across thousands of tables, the mix goes negative.
That makes sense.
So mix was down a tiny fraction, negative 0.3%. And then we get to the third and arguably most important component, traffic.
The actual physical number of humans walking through the front door.
Right. And traffic was down negative 1.4%.
So the cynical take is validated. Traffic is down, people are staying home, and the company is just raising prices to cover up the fact that fewer people are walking through the double doors.
Well, that would be the conclusion if you stopped reading the transcript right there.
Wait, there's more?
Oh, yeah. You have to factor in the hidden external variables that management explicitly quantified on the call.
What kind of variables?
They noted that severe, unseasonable weather negatively impacted sales by a quantifiable 1.7% during this specific quarter.
Wait, let me do the math on that. If overall traffic was down 1.4%, if traffic was down 1.4%, but winter storms and severe weather artificially chased away 1.7% of the business.
You see where this is going.
They didn't lose traffic. On a level playing field, if you adjust for the weather anomalies, their core customer traffic actually grew by 0.3%.
Exactly.
While their competitors are bleeding out customers, they actually gained foot traffic. That completely flips the narrative for me.
It fundamentally changes the thesis. Keeping traffic flat or slightly positive in today's incredibly tough macroeconomic environment is a Herculean feat.
I mean, we are seeing fast food giants and massive quick service chains loudly complaining in their earnings calls about losing lower income consumers, right?
Oh, totally. Seeing massive drop-offs in frequency, yet the Cheesecake Factory is holding the line.
It tells me that the core guest isn't alienated. They noticed the 3.3% price increase, but they still showed up. That is the definition of pricing power.
It really is.
And that tiny 0.3% drop in mix, that feels like a win too. People aren't sitting at the table aggressively pinching pennies. They're still ordering the appetizers. They're still getting the drinks.
Management actually highlighted that the negative 0.3% mix represents a material stabilization from previous quarters.
Oh, really?
Yeah. The consumer behavior is normalizing. They aren't fiercely managing their checks like they were late last year. They've accepted the new pricing reality and are returning to their normal ordering habits.
Which brings up an obvious question. If traffic is essentially flat or slightly up, and guests are still ordering full meals, the kitchens must be operating at an insane velocity.
They are.
The transcript mentioned their core annualized unit volumes, AUVs, hit nearly $12.8 million. I know it's a big number, but give us the context. How does that compare to a standard restaurant stock?
An AUV of $12.8 million per location is virtually unheard of in the traditional casual dining space.
Really? Unheard of.
For context, most of their direct competitors, the neighborhood bar and grills, the standard sit-down chains, they are absolutely thrilled if they can hit $3 or $4 million a year out of a single physical box.
And Cheesecake is doing almost $13 million.
Right. That means their real estate is hyperproductive. But, as we discussed with the menu, the kitchen logistics required to execute 250 distinct items at a $13 million volume without the entire system collapsing into total chaos requires a sophisticated operational moat.
A moat that competitors simply cannot replicate overnight.
Exactly. It's incredibly difficult to duplicate.
It's mind-boggling.
Yeah.
Think about the sheer tonnage of chicken, pasta, and produce moving through those specific kitchens every single week.
It's an industrial scale of food prep.
But it makes me wonder, what is the actual strategy driving this volume inside the four walls right now? When I see traffic holding steady, my immediate assumption is that they must be sending out 2-for-1 coupons or heavily discounting to buy that traffic.
Which is what a lot of chains do.
Yeah, but I didn't see any of that in the sources. How are they maintaining volume without cheapening the brand?
They are leaning into a very specific strategy, which is menu innovation over discounting. When consumer spending gets tight, the panic reflex for a lot of restaurant executives is to start dropping coupons, promoting deep value meals, or slashing prices just to keep the dining room looking full.
It's a race to the bottom. You basically train the customer to only show up when they have a coupon.
And it absolutely destroys your margins. Not to mention it degrades the perceived quality of the brand. Cheesecake Factory flat out refuses to play that game.
So what do they do instead?
Instead of discounting to induce visits, they introduced a new category of bites and expanded their bowl options.
And the data from the call shows this is working brilliantly. Management pointed out that instead of customers trading down like a guest deciding to buy a cheaper bite instead of a $25 full entree, they're actually adding these new, smaller items to their existing orders.
Exactly. So it's check building, not check management.
That is so smart.
It taps into a fascinating psychological dynamic. A guest sitting at a table might balk at ordering a second $25 entree or a massive appetizer platter.
Right, that feels too expensive.
But they will happily order their standard meal and then add on an $8 bite to share at the table.
It feels lower risk.
Yeah, it feels like they are customizing their experience, and it provides a sense of novelty. For the restaurant, it boosts the overall check size, keeps the menu feeling fresh, and completely avoids the brand damage that comes with heavy, desperate discounting.
That makes perfect sense. Now, there was a second driver behind these sales numbers that genuinely surprised me. Digital engagement. The sources detail the rollout of the new Cheesecake Rewards app, and the metrics are wild.
The adoption rate was phenomenal. During its launch week, it hit number 3 overall in the App Store across all categories.
All categories, not just food.
Across all categories. And it secured the number 1 spot in food and drink.
Number 1 in food and drink. That means they were beating out the massive coffee chains, the ubiquitous pizza delivery apps, the fast food giants that rely almost entirely on mobile ordering.
It was a huge launch.
But my question is, how are they actually utilizing this? Because a lot of restaurant loyalty apps are just digital punch cards. You buy 10 sandwiches, you get 1 free.
Right, the classic punch card model.
It just gives a discount to people who are already going to eat there anyway. That doesn't grow the business. It just gives away margin.
You've hit on the exact flaw of legacy loyalty programs. But management explicitly noted that this rewards program is designed to expand the funnel and acquire brand new guests, not just subsidize existing ones.
But how exactly does a sit-down restaurant app acquire a new guest? If I don't eat at the Cheesecake Factory, why am I downloading their app?
They do it through exclusive access and by shifting the delivery paradigm. They utilize targeted marketing to offer app-exclusive menu drops, early access to seasonal items, and most importantly, they are shifting users away from third-party delivery apps like DoorDash or Uber Eats and onto their own digital channels.
So when a user orders directly through the Cheesecake app, The company avoids those massive third-party commission fees.
Exactly. And they capture the holy grail of modern retail first-party data.
And they are actively deploying that data. The operations team talked about moving toward targeted, behavior-based personalized offers.
This is where lifecycle management comes into play. Because they own the data, the app learns your habits.
So it's not a generic coupon blast?
No, not at all. If the algorithm sees that you consistently come in for lunch every Tuesday, it is never going to offer you a Tuesday lunch discount. Why discount a guaranteed visit?
Right.
Instead, it might offer you an incentive to try a Thursday dinner, or it might suggest adding a specific dessert you've never ordered based on the flavor profiles of your past entrees.
That is brilliant.
It drives incrementality. It uses highly efficient marketing dollars to get the guest to spend just a little more or visit just one extra time a month.
It's precision-guided marketing instead of carpet bombing the zip code with flyers.
Yeah.
I love that. Now, the third driver the CFO brought up takes us out of the restaurant and into the broader macroeconomy.
The K-shaped consumer.
Yes. They attributed a lot of their resilience to the K-shaped consumer.
Yeah.
We need to translate this concept because it explains so much of what we are seeing across the retail landscape right now.
A K-shaped economic environment describes a scenario where the economy is splitting into two diverging trajectories. It quite literally looks like the letter K.
Okay, so what's the top arm?
The top, upward-sloping arm of the K represents higher-income households. Despite inflation, this demographic is actually doing quite well. Their home values are up, their stock portfolios are performing, their jobs are largely secure, and their wages have kept pace. They have healthy discretionary income.
And the bottom, downward-sloping arm.
That represents lower to middle income households who are being severely squeezed. They are bearing the brunt of inflation at the grocery store. They're dealing with higher interest rates on credit cards and auto loans, and their pandemic-era savings are entirely exhausted.
So they're pulling back aggressively on anything that isn't an absolute necessity.
Exactly.
And according to the earnings call, management is highly confident that their brand portfolio caters directly to that top upward-sloping arm of the K.
And the demographic data supports it. Their locations are typically anchored in premium real estate, think high-end malls, affluent lifestyle centers.
So the portfolio of brands naturally filters for a higher income cohort.
Right. So even amidst alarming headlines about corporate layoffs or a cooling broader economy, the actual disposable income for their specific target demographic remains robust.
The sources also touched on a fascinating shift in consumer psychology within that demographic. Even if they have the money, they're making different choices.
Yeah.
Management noted that consumers are increasingly prioritizing dining experiences over material goods.
It's the manifestation of treat culture or accessible luxury.
Accessible luxury. I like that.
Yeah, even for a higher income household, buying a new luxury car at a 7% interest rate or booking a $10,000 European vacation might feel a bit too extravagant right now.
So they delay the big stuff.
They might delay those massive durable goods purchases, but they still have the psychological need for the experiential luxury of a nice night out. A $150 dinner for two at a premium casual dining spot fits that accessible luxury profile perfectly.
Because it provides the dopamine hit of a luxury experience without the massive financial commitment.
Exactly.
Okay, I follow the logic. The top arm of the K is still spending, the app is driving frequency, and the menu innovation is building the check size. But I had to challenge this narrative because looking at the income statement, something doesn't add up.
What's missing?
We hear constant daily reports about margins in the food industry getting absolutely crushed by inflation. Anyone who has been to a grocery store recently knows that food is expensive.
It certainly is.
I have to assume that buying massive industrial pallets of restaurant supplies is also exponentially more expensive. If they only raised menu prices by 3.3%, how on earth are they not getting completely squeezed on the bottom line?
Well, if you look strictly at the mechanics of their cost structure for the quarter, you'll see exactly why Wall Street was so pleased. Their restaurant-level profit margins didn't shrink. They actually expanded.
Expanded?
Yes, they increased by 10 basis points year over year, landing at 17.5%.
They expanded their profit margin while only taking a 3.3% price hike. How is that mathematically possible when beef and seafood prices are spiking?
We have to unpack the cost of sales line item. Cost of sales actually decreased by 10 basis points as a percentage of revenue. And the secret hero of the quarter, which management called out specifically, was dairy.
Dairy costs. Well, I suppose when the word cheese is literally the first word in your company's name, dairy is a fairly massive line item.
It is a foundational commodity for them. And the commodity markets fluctuated significantly in their favor regarding dairy prices during Q1.
So cheese got cheaper.
Basically, yeah. This favorable pricing acted as a perfect natural counterbalance to the inflationary pressures they were facing with beef and seafood.
That's incredibly fortunate.
Essentially, the savings they realized on cheese, butter, and cream neutralized the premium they had to pay for steaks and shrimp. The food cost basket balanced itself out entirely.
That is either incredible luck, masterful supply chain hedging, or a combination of both.
Probably a bit of both.
But food is only half the equation.
Yeah.
What about the human beings cooking the food and serving the tables? We know labor costs are astronomical right now. Minimum wages are up, and the competition for reliable hospitality workers is fierce.
True. And yet, labor as a percentage of sales actually declined by 20 basis points.
Wait, declined? Did they cut wages? Did they slash staff on the floor?
Not at all. That would degrade the guest experience, which would eventually kill those high AUVs we talked about. The reduction in labor costs was driven entirely by labor productivity gains.
Meaning the staff they currently employ is simply getting faster and better at their jobs.
Precisely. The operations team highlighted a massive success story regarding retention. They are seeing incredibly strong retention rates across both hourly staff and management.
And retention is key.
In the restaurant business, high retention is the absolute holy grail of profitability.
Why is that exactly?
Think about the hidden costs of turnover. When you are constantly hiring and training new line cooks, your kitchen runs slower. Ticket times go up.
Right. Mistakes happen.
Brand new cooks make mistakes, which leads to comped meals and massive food waste. When you have seasoned, experienced staff who have been on the line for years, the kitchen operates like a synchronized machine.
So everything just moves faster.
Exactly. Servers flip tables more efficiently because they know the menu inside and out. The sheer operational velocity increases, which means you can handle higher sales volumes with the exact same amount of labor hours.
So they took those financial gains from labor productivity, and what did they do with them?
They use them to absorb other inflationary pressures. Specifically, management noted that these productivity gains completely wiped out the increased costs of group medical insurance.
That is wild. The efficiency of the dishwashers, the line cooks, and the servers literally paid for the rising healthcare premiums of the entire company.
It's a masterclass in operational discipline.
It really is. It proves that margin expansion doesn't always have to come from gouging the customer. It can come from running a tighter ship.
It's the kind of fundamental operational strength that long-term investors look for. It shows the executive team isn't just focused on top-line vanity metrics, they are managing the actual mechanics of the business.
Okay, before we transition to their future guidance, we need to talk about the rest of the family. The Cheesecake Factory isn't a monolith anymore.
Far from it.
They have been quietly, methodically building a portfolio of other restaurant concepts, and looking at the data, the absolute standout star here is Flower Child.
Flower Child was a revelation in this earnings call. As we touched on earlier, they delivered a 10% comparable sales increase.
Which is huge.
But to really grasp the momentum, you have to look at the two-year stack. Over a two-year period, their comps are up an astounding 15%.
That is massive. And for anyone who hasn't been to one, Flower Child is a completely different vibe than a traditional Cheesecake Factory.
Very different.
It's health-focused. Everything is made from scratch. Lots of organic ingredients. It operates in that elevated fast casual space. You order at the counter, but the food and environment feel like a sit-down restaurant.
It's positioned perfectly for current consumer trends, and the unit economics they are reporting are phenomenal. The annualized AUVs for Flower Child hit $4.9 million, which represents a new quarterly high for the entire concept.
Wow.
But the number that should really make investors pay attention is the margin. The restaurant-level profit margin for mature Flower Child locations hit 19.6%.
Almost a 20% profit margin in the restaurant business. That is exceptional. The industry average is usually hovering around 10 to 12% if they're lucky.
It's elite tier profitability. And management specifically noted that Flower Child is meaningfully outpacing the broader fast casual segment. They aren't just riding a wave, they're actively taking market share away from traditional quick service and fast casual competitors.
Why do you think that is? What is Flower Child doing that the traditional fast casual places aren't?
It comes back to the value proposition. Traditional fast food and fast casual chains have had to raise prices so aggressively over the last 3 years to offset their own labor and food costs that the value element has completely evaporated.
Oh, that makes sense. Like a burger combo, suddenly almost $20.
Exactly. If you were going to spend $16 or $18 for a mediocre fast food combo meal served in a paper bag, consumers are realizing they can spend $19 at Flower Child, get a made-from-scratch healthy meal, and sit in a beautifully designed dining room.
So the price cap is closed, so consumers are trading up for better quality.
It's the K-shaped consumer again, but it wasn't all sunshine across the entire portfolio.
Where there was one weak spot.
If we look at North Italia, their modern upscale Italian concept, the numbers tell a different story. Comparable sales there actually declined by 2%.
Yes, and if we dig into the underlying components of that negative 2% comp, we see a concerning trend. Price was up 3%, mix was positive 1%, but traffic dropped a severe 6%.
A 6% drop in foot traffic is significant.
Yeah, that means they are legitimately losing guest frequency. What is driving that drop? And more importantly, what is the fix?
Management was very transparent about this. They acknowledged the traffic drop and they pinpointed the exact issue. First, it is important to separate mature locations from new ones.
Okay, why is that distinction important?
Because new North Italia locations are actually opening with gangbuster numbers. During the call, they highlighted a brand new location in Brea, California that recorded the busiest opening week in the entire history of the North Italia brand.
Okay, so the brand itself isn't broken. It still has incredible pull and excitement when it enters a new market. The issue is strictly with the older, established locations.
Correct, and the analysis showed that the traffic drop in mature locations was heavily concentrated in the lunch day part.
The lunch crowd vanished.
To fix this, they are aggressively rolling out a dedicated, revamped lunch menu. They are introducing lighter options, completely refreshed salads, and new protein additions.
Because no one wants a heavy bowl of pasta at noon on a Tuesday.
Exactly. They recognize that a heavy, expensive pasta dish might not be the right value proposition for a Tuesday afternoon business lunch, so they are pivoting the menu to capture that specific midday occasion.
It shows they are reacting to the data in real time, rather than just hoping the traffic comes back on its own. They also mentioned opening a new location of the Henry in Phoenix, which is part of their FRC Fox Restaurant Concepts portfolio.
And the volume on that opening was staggering. It opened doing over $280,000 a week in sales.
Which is incredible.
If you extrapolate that out, it translates to an AUV of over $14 million.
It genuinely seems like whatever physical concept they touch right now, whether it's Italian, healthy, fast casual, or neighborhood spot, they possess the operational blueprint to scale the volume to astronomical levels.
They really do.
Okay, we've thoroughly examined the quarter that just ended. I want to transition to the future. Q1 was undeniably strong, but what exactly is management promising the street for the rest of 2026? Let's dive into the management guidance.
They laid out very specific targets. For the upcoming second quarter of 2026, they anticipate total revenues to land between $990 million and $1 billion.
They are right on the cusp of crossing that psychological billion-dollar threshold in a single quarter.
It's a huge milestone. And they expect net income margins to hold steady at around 5.5% at the midpoint of that sales range.
And what about the macro view for the full year 2026? What is the ultimate target?
For the full year, they are projecting total revenues of approximately $3.91 billion.
Okay, the revenue targets are solid. But here is the number in the guidance that made me sit up and reread the paragraph. We need to talk about their expansion plans.
The CapEx.
Yes, they announced they are deploying $210 million in capital expenditures to open as many as 26 new restaurants this year.
It's aggressive.
To break that down, they're targeting up to 6 core Cheesecake factories, 6 to 7 North Italias, 6 to 7 Flower Childs, and 7 FRC restaurants.
It is a massive, highly aggressive development pipeline, and they noted that roughly 3/4 of those new openings are slated for the second half of the year.
Let me put this level of expansion into perspective because it feels counterintuitive. It feels like they're stomping on the gas pedal while all of their competitors are actively hitting the brakes.
That's a fair assessment.
We just spent 20 minutes discussing how tough the macroeconomic environment is. We talked about a K-shaped recovery that is literally leaving half the consumer base behind. We talked about inflation squeezing the middle class. To plan 26 new restaurants which requires massive upfront capital, in a year where the broader consumer is supposed to be pulling back. Are they getting over their skis here? Is this a dangerous allocation of capital?
It's a calculated, aggressive acceleration, and the confidence to do it all comes back to a point we discussed earlier, management retention.
Oh, the bench strength.
Exactly. During the Q&A portion of the earnings call, the Wall Street analysts actually pressed them on the exact issue. They specifically asked how a company can feasibly grow a brand like Flower Child so rapidly without the operational quality falling apart.
Because historically, when restaurant chains expand too fast, the food quality drops, service suffers, and the brand equity is destroyed. So what was the CEO's answer to the analysts?
The CEO made it crystal clear they aren't just signing leases, opening doors blindly, and hoping they can find someone off the street to run them.
Which is how a lot of places fail.
In the restaurant industry, the actual constraint on growth isn't access to capital, it's leadership. Because Cheesecake Factory's management retention rates are at historic highs, they already have the pipeline built.
So they have the people ready.
Yes. They have trained general managers, seasoned executive chefs, and experienced kitchen managers who are ready to step into these new locations on day one.
I see. So they are building the human infrastructure, the management bench first, and only then do they build the physical restaurant around them.
Exactly. It completely de-risks the expansion. And the second reason they feel confident deploying this capital is their cost visibility.
Cost visibility.
Management stated they forecast their effective commodity and labor inflation to be in the low to mid single-digit range for the remainder of the year.
So they aren't expecting any massive surprise spikes in the cost of doing business.
Right. When you have stable, predictable supply chain costs and you have a deep bench of proven veteran operators deploying $210 million into new units that generate $5 to $13 million AUVs is a highly accretive move for shareholders.
It's investing in high-yield assets. Okay, we've walked through the impressive revenue beats. We've analyzed the menu innovation and the digital funnel. We've unraveled the margin magic with the dairy cost. And we've vetted the aggressive 26-unit growth plan.
We've covered a lot of ground.
It is time to synthesize all of this. Let's get to the bottom line. I want your final, unvarnished verdict. Based on everything in this source stack, what does this mean for the retail investor who is holding cake in their portfolio, or maybe screening the stock right now? Is this a bullish or bearish signal?
Based comprehensively on the data, the operational metrics, and the forward guidance in this call, this is a definitively bullish signal.
Don't hold back. Lay out the core thesis for why.
It comes down to two foundational pillars: pricing power and operational discipline. This is a company proving in real time that it can navigate an exceptionally difficult, fractured consumer environment without degrading its brand equity through desperate discounting.
Because they have that pricing power.
They passed along a 3.3% price increase to offset inflation, and their core guests absorbed it and kept walking through the doors. The legacy Cheesecake Factory brand remains an absolute cash machine, churning out massive $12.8 million unit volumes that competitors can only dream of.
But the thesis requires growth. And they aren't just a one-trick pony relying solely on the legacy brand anymore.
That is the crucial shift. For years, the bear case against the Cheesecake Factory was always a question of scale. People would say, where's the future growth? You simply can't build a massive 10,000 square foot Cheesecake Factory on every single suburban corner. The market will saturate.
Right.
But this earnings call proves they have solved that terminal growth problem. Their incubation portfolio, specifically Flower Child, provides the high growth catalyst the stock needs.
Because it's a smaller footprint, but huge margins.
Exactly. Flower Child is actively taking massive market share from fast casual competitors, generating near 20% restaurant-level margins, and scaling rapidly with excellent unit economics.
And they are taking all of this foundational operational excellence and projecting it forward with immense confidence. They are officially targeting 25 basis points of margin expansion for the full year across the entire portfolio, while simultaneously growing their physical footprint by 26 locations.
Add to that their capital allocation strategy. They are self-funding this aggressive growth. They are buying back their own stock, reporting $18.4 million in share repurchases this quarter alone, and they are paying a dividend, all while expanding profit margins.
That's a powerful combination.
From a fundamental retail investing perspective, management is playing a very strong hand incredibly well.
All right, that brings us to the end of our core analysis. This deep dive is entirely designed to keep your portfolio informed, to cut through the noise of the financial press and give you the fundamental drivers.
We covered the real story today.
We did. We've dissected the resilience of the K-shaped consumer, the hidden impacts of weather anomalies and commodity hedging, and evaluated a $210 million bet on future market share.
It serves as a great reminder that sometimes the most operationally complex businesses yield the most robust, defensive financial results.
But before we officially sign off, I want to leave you with one final provocative thought to chew on, something that builds on everything we've talked about today, but looks a little further down the road.
Let's hear it.
During the call, management consistently noted that their extreme menu flexibility allows customers to order exactly what fits their highly specific dietary needs.
Right?
If you want a massive decadent slice of Oreo Dream Extreme cheesecake, you got it. If you want steamed salmon, plain broccoli, and a glass of water, they have that too, and they are happy to serve it.
It ties right back to that spiral-bound novel of a menu we started the show with.
Precisely. Now consider the massive tectonic shift currently happening in the health and wellness space with the explosive rise of GLP-1 weight loss drugs like Ozempic and Wegovy.
Oh, this is a huge topic right now.
These medications are fundamentally altering long-term consumer eating habits. They are drastically reducing appetites, eliminating cravings for sugary foods, and shifting dietary preferences toward higher protein, lighter, nutrient-dense meals.
Which is terrifying for a lot of traditional food companies.
Exactly. For the last year, Wall Street has been absolutely terrified that this pharmaceutical trend will destroy restaurant stocks, specifically targeting chains that rely on heavy caloric meals.
Like a dessert chain, theoretically.
Right. But looking at this data, it raises a fascinating question. Could it be that the Cheesecake Factory's giant, endlessly customizable menu actually makes it the ultimate defensive restaurant stock against the GLP-1 wave for the next decade?
It's a compelling theory. When your kitchen has the logistical capability to cater to the person celebrating a blowout birthday with a heavy pasta dish and simultaneously cater to the person at the exact same table who is strictly managing their macros on a GLP-1 protocol,
You win both customers.
you possess a structural advantage that a focused, limited menu burger or pizza chain simply cannot match.
It's definitely something to think about the next time you sit down and are handed that 21-page menu. The complexity might just be the moat. Thanks for joining us on this deep dive. We will catch you next time.